Welcome to SPM Principal Accountant. Let's have a very brief overview of what accounting is about. Let's say on Monday, you have 100 ringgit in your pocket. You saw a very interesting t-shirt that your neighbor has, brand new one, and you buy it from him for 18 ringgit. Then you go around looking for interested buyers, and you manage to find one on a Saturday, and you sell it to your classmate for 40 ringgit. So you've made your first business deal. So on Sunday, you want to take stock of your situation. Did you make any profit from the deal? Let's see. You sold it for 40 ringgit cash to your classmates. So this is the selling price minus the cost of the t-shirt to you. And what do you have? You have a profit of 22 ringgit. So your first business deal earned you 22 ringgit profit. And on Sunday, you know, right, you've calculated, you've made a profit of 22 ringgit. But what do you have on Sunday? Let's check. What do you have on Sunday? Do you still have the t-shirt? No. You've sold it to your friend. Do you have cash? Yes. How much do you have? Let's do a calculation. You started off with 100 ringgit. You paid your neighbor 18 ringgit to get the t-shirt, and you received 40 ringgit from your friend when you sold it to him. So at the end of the day, you have 122 ringgit cash. Alright? From accounting point of view, this information here is presented in what we call income statement, because it basically shows you how much profit you've made on your business. The money you receive from sale of your product is normally called the revenue. The cost that you have to pay to get the t-shirt is generally known as the expenses. So revenue minus expenses equals profit. And this will be presented in a statement called income statement. This tells you how much money you've made. But at the end of the week, what do you have left with you? As we determined just now, you have a cash balance of 122 ringgit. This is what you have after your business deal. And in the accounting point of view, what you have or what you owe at a particular point in time is presented in a statement called the balance sheet. But this balance sheet is not a complete balance sheet. Yeah, we'll come to it later. The other thing about this statement is these transactions took place during a week's time. So therefore, we would like to know too, the income statement that you have just presented, does it include transactions for a year, or does it include transaction for a month? We would like to know, right? So in your case, income statement for 1 week. So we'll add for the week ended, say Sunday is 7th January 2014. So this will be the heading for your income statement. Now the proper heading for your balance sheet would be, because this is what you have on Sunday itself, only Sunday. It's not what you have on Saturday, because what you have on Saturday would be different. On Saturday, before you sold the t-shirt to your friend, you will still have the t-shirt. But on Sunday, your position has changed. So you have to be very specific as to on which day is this balance sheet, right? So because this balance sheet is on a Sunday, we will write it as balance sheet as at 7th January 2014. Right? Now, if this income statement is for transactions over a month, then you would call it income statement for the month ended the last day of the month. Now, and then balance sheet as at is always as at a particular date, because the next day the composition of what you have and what you owe would change. You may have used cash to buy petrol, etc. So you have to be specific that whatever you're listing down under your balance sheet is valid only on this particular day. Income statement from accounting point of view basically shows you the financial performance of the business, of your business, and balance sheet would show you the financial position. So when people talk about financial position, they're looking at what you have, what you owe on a particular point in time, right? And when they talk about financial performance, they're basically looking at how profitable your business is. Now suppose on Wednesday you received 50 ringgit from your parents for your birthday. The question is, do you add this event into the financial statements that we have done up just now? So is this received as a result of your business transaction, as a result of selling t-shirts, or is this a personal event, a personal gift received as a result of your birthday? So do you need to add this 50 ringgit into the financial statements? So let's determine this income statement. Is it your personal income statement, or is it the income statement to show the performance of your t-shirt business? It is to show the profitability of your t-shirt business. So we need to put a heading here. Let's say t-shirt business. Balance sheet is also for the t-shirt business. Therefore, as a result of this, if you add the birthday gift of 50 ringgit into your revenue, you will have a total revenue of 90, you will have an expense of 18, and you will have a profit of 72 ringgit. Let's see whether this figure is realistic. Did you earn 72 ringgit as a result of buying and selling t-shirts? No. Therefore, it is misleading to add your personal gift of 50 ringgit here, because then it will give you a misleading profit figure. Then you thought, wow, it's so profitable, I don't have to sell many t-shirts in order to survive. No. So we have to apply what we call the entity concept in accounting. What does this entity concept mean? It basically means when you set up a business, you have to view the business as a separate entity from all other entities. So it sort of assumes a life of its own. Whatever revenue it generates, you will record it for the business. Whatever expenses it incurs, you will record it for the business. Whatever personal things, like your birthday gifts, or when you buy a car for personal use, or when you treat your girlfriend to a dinner, all those are personal expenses or personal revenue. You will not include it into your business. This is so that you can have an accurate picture of the financial performance and financial position of your business. So this is the first concept you have to understand, right? Let's complete the balance sheet that we started just now. You have decided to start a t-shirt selling business. Let's give it a name. Let's call it Quirky Shirt. So you've invested 100 ringgit into Quirky Shirt. Can we check what Quirky Shirt has on the day you invested 100 ringgit? Let's look at the balance sheet. And it will be on the day you invested. So it's 7th, no, it's not 7th January. It's actually 1st January, yes? 1st January 2014. What does Quirky Shirt has? Quirky Shirt has cash of 100 ringgit. Now, because Quirky Shirt assumes a separate identity from accounting point of view, just treat it like another person, alright? So Quirky Shirt on 1st January 2014 has cash of 100 ringgit. Now, can anyone claim this 100 ringgit from Quirky Shirt? Yes, you as the owner can claim the 100 ringgit from Quirky Shirt because you invested it. So if you decide to close down Quirky Shirt, this 100 ringgit will be paid back to you. So from Quirky Shirt's point of view, remember, it's a separate entity from you, it's a separate kind of person from you. So it has cash of 100 ringgit, but Quirky Shirt also owes you as the owner 100 ringgit. Now, therefore, in Quirky Shirt's balance sheet, it also has amount owed to owner, and we call it owner's equity, 100 ringgit. So there's a cash of 100 ringgit and amount owing to owner of 100 ringgit. You don't add these two together. It's like one is left hand and the other one is right hand. What Quirky Shirt has on one hand, cash 100 ringgit, it also owes the owner 100 ringgit. Alright, so the amount will be equal. And this brings us to the accounting equation. So from here we can see the accounting equation is assets of Quirky Shirts is equals to the owner's equity of Quirky Shirts. So asset is as cash, and here is owner's equity. So there's a cash of 100 ringgit equals to amount owing to owner of 100 ringgit. So this is called the accounting equation. And at any one time, assets of the business must be equals to the owner's equity. The business has assets of 100 ringgit, but where did it get its money from? Who finances these assets? In this case, the owner finances the 100 ringgit. So therefore, the assets of the business is equals to the owner's equity, the amount it owes the owner. We'll expand it later to include one more element, but at the moment, this is your accounting equation. What have you learned in this lesson? You have learned how to prepare a very brief income statement as well as a balance sheet. We have also discussed the entity concept and the accounting equation, which is assets equals to owner's equity. So what is accounting? Accounting is a process of identifying transactions of the business. Now, the source for this identification process would be your invoices, receipts, debit notes, credit notes, bank statements, etc. After identifying the transactions of the business, you would then measure these transactions in monetary term, and then you would record it in the accounting books, such as journals and ledgers. From these accounting records, you will then prepare the financial statements, which is your balance sheet and your income statement. And this information in the financial statements will be used to communicate economic information of the business to whom? To the users of the financial information, in order to help them to make informed judgments and decisions. So this whole process is what accounting is all about. And you will learn how to do this, and this. These last two functions will be on the user side. And these users will use this information to decide whether, for example, to invest in this company or not, or whether to buy the shares in this company.